Hi, this is Phil Greenwood from the University of Wisconsin. This is our fourth in a series of valuation sessions as part of the Lean Finance series. Remember that we're looking at valuation techniques that are very particular right now to the early stage company and that they are privately held. Now, each of the different sections you see in this rectangular box, they typically be different techniques applicable to each of the stages or types of company, be it private or public. And we're trying to hit at least the early and growth stage for the privately held ones as much as possible. As we discussed in the previous Part 3 session, probably the most common valuation technique used by venture capitalists and sophisticated investors in valuing early stage investments when there's no profits, when there's no revenues, is to use what we call the comparable transaction technique. And as we've talked about throughout, what we're really doing is just, again, using that house analogy. When you go to buy a house, you look at what other houses are selling for, and that gives you kind of a guide as to what your price should be that you pay or you sell it for. Similar to like biotech or early stage high-tech firms. You know, you try to spend a lot of time and due diligence on finding similar companies that are in the same or similar industry products market, about the same age or life stage, and are pretty much in the same geographic region as your own. Because a lot of times what companies or investors are trying to do is they're trying to get a sense of XYZ company sold for or got an investment of $5 million, certain kind of financing, and the investors received X% ownership. That's what they're trying to do, is give them a proxy for how much ownership they should require on their investment, and vice versa. The entrepreneurs are trying to understand, what percentage ownership they should give up to the investors. Now, the second most common technique, or a very common technique, is net present value. And as you see here, this is an example of a company from Wisconsin about 8 to 10 years ago, and you see the projection, the 5-year projection of its revenues, costs, and also down to its EBITDA, meaning its cash flow before depreciation and amortization. This is as of 12/31/2000, so all of these numbers are projections. The company had been around for a little while, and we're seeking, I believe it was about $10 million in financing. But you can see losing a lot of money in the first 2 years, or at least negative cash flow, and then by year 5, a pretty sizable, not only revenues, but also EBITDA of $37 million. So if we were to use net present value, first thing we'd have to do would be try to estimate what discount rate our investors would want. This company, because it was looking at about its second round of financing, had some sales, no profits yet, pretty far along the proof of concept stage. We thought 30% in this case was pretty relevant as far as a present value factor. So as you can see, we took the EBITDA, forecasted that out the 5 years from the previous slide, and then we estimated a terminal value. And here's an example of what we mean by a terminal value. We assumed the company would sell at the end of 2005, and using kind of averages from the industry or similar companies, we figured, it would sell for about 10 times EBITDA, or in this case, $370 million. Well, you can see that once you forecasted it and you apply the present value factors, then we convert all the future cash flows or future EBITDAs into a present value. Now we can come up with some kind of what's the net present value based on EBITDA. What we're trying to do when we do this is something called the venture capital method. And what we're doing is using DCF, or discounted cash flow, to estimate the company value to give us a sense of what we call the pre-money investment value and the post-money investment value. In other words, what's the company's total value or total equity value after we receive the investment, or the pre-money, the value before the investment. So in this case, we did the discounting at 30%. We came up with a net present value of $109 million. We estimated the company would need $10 million in financing. So we said, well, this company's post-money would be equal to the NPV at 30%, or $109 million. The pre-money valuation would be worth 109 minus the amount of investment needed, or $99 million. Once we have those numbers, then we can give an estimate, a rough estimate again, what the ownership percentage will be that we give up. The $10 million divided by the post-money valuation of 109, in this case, gave roughly about a 10% ownership. Now, this is usually something that's very, very subjective, and a lot of time is spent negotiating. Investors will say for $10 million, they will constantly argue that the projections are way too overly optimistic. They're going to need a lot more ownership. There's a lot of uncertainty involved, so on and on and on. The entrepreneur will take the other side and say, well, we think this 10% is reasonable. But at least it gives you a foundation for value.